All right, guys, Netflix just published its Q4 FY23 performance. And so today we want to take a deep dive in the numbers and also talk about that massive WWE deal that they just announced. All right, I'm Bertrand and I'm the founder of App Economy Insights.
And I'm Stephanie, tech industry leader and creator. All right, so let's kick it off. So, revenue grew 12% year over year to $8.8 billion, and it was slightly ahead of guidance. This growth was fueled by the exceptional paid membership additions, and in Q4, management expects an acceleration to 16% year over year.
All right, so if you look closer at the operating profit, the operating margin was ahead of expectation. It was 17% compared to a 13% guide. And that improvement was primarily thanks to the slight uptick in revenue compared to expectations, but also they spent less than they thought.
Right. And Netflix has had a really scalable business model with no near term margin ceiling.
That's right. So this operating margin could continue to improve. And on the cash flow side, they've actually generated $7 billion in free cash flow in FY23. And as a result, they've done quite a bit of stock buybacks at a rate of about $2.5 billion per quarter.
Netflix's strong financial position is really at odds with other streaming giants. Disney, Warner Brothers, and Paramount, they've all struggled with losses on their direct to consumer initiatives. And meanwhile, Netflix is basically printing money. Many legacy entertainment companies are all trying to consolidate more IPs under the same roof.
Right. And in that regard, management actually had a brutal quote in the shareholder letter. I'm going to read it to you. They said, "It's logical to expect further consolidation, particularly among companies with large and declining linear networks. We are not interested in acquiring linear assets, nor do we believe that further M&A among traditional entertainment companies will materially change the competitive environment."
Okay, Netflix. Well, in short, good luck if you are not a streaming platform named Netflix.
Right. Okay, so there are two factors that impact Netflix's revenue. One is the number of subscribers, and the other is the average revenue per subscriber, right? So let's look closer at the subscribers themselves.
So, Netflix has been cracking down on password sharing, as you all know, since May 2023 in the US and parts of Europe. And it has led to a surge in new signups since then. Netflix counted 260 million paid memberships at the end of FY23. They also added over 13 million in Q4 versus 9 million expected, which is up 13% year over year. And it's the best quarter of membership ads since early 2020, which, was boosted by the pandemic, and the largest Q4 ever. So it's working.
Yep. And if we break it down at the territory level, the growth was most notable in the Asia Pacific region, which grew 19% year over year, but also in Europe that grew 16%. But overall, all regions really benefited with 2 million subscribers uptick at least during the quarter.
And we're going to hear from the other streaming giants in the coming weeks, but here's a look at how far ahead Netflix really is. And keep in mind that Disney Plus has roughly 50 million subscribers in India through Hotstar, and they pay less than $1 per month.
All right, and you may notice that Amazon Prime is not included in this chart, and that's because they don't share their data. Nevertheless, they have an estimated 200 million subscribers for Amazon Prime. There is a catch though. Not all of these subscribers are interested, let alone watching Amazon Prime Video.
Yeah, I think I'm in that group.
All right, so one of the mantras I've learned from my time in the video game industry was to say that the user is king, but engagement is queen.
Yes, I mean, as creators, we feel the same. And you're going to hear this from any company in the entertainment industry. Engagement is the North Star because it bleeds into all the other performance metrics like higher retention, lower acquisition costs, and higher revenue per member.
Yep. And so the best proxy for engagement that I've found, at least, is the time spent watching Netflix. And for that, we have Nielsen that provides a monthly market measurement of how Americans spend their time watching TV.
In December, Netflix represented 7.7% of TV time, which is more than two times the market share of the closest premium SVOD competitor, which is Prime Video. YouTube, excluding YouTube TV allocated to other, has been slightly ahead of Netflix since February 2023.
And while Netflix has lost the crown to YouTube, right, it's been a while now on US TVs since the early 2022, it has maintained an impressive lead over other streaming rivals. And critically, it has kept a stable market share, as you can see here, basically around 7 to 8%. And you have to consider that the market is still growing, right? So by just maintaining a somewhat comparable share of the market, they are steadily growing.
All right, so let's talk about Netflix games. In November 2021, Netflix launched a gaming section on its mobile app, an initiative led by Mike Verdu, who's a former EA and Facebook executive. And in short, Netflix subscribers can download exclusive games on the App Store at no additional charge. They've already developed over 75 mobile games, and in December, Netflix launched its biggest games yet with the mobile port GTA The Trilogy, which includes GTA 3, Vice City, and San Andreas.
And so far, the only measurement of success we really have for Netflix games has been the download of said games. So far, the only measure of success of Netflix games has been the downloads data that we can collect from intelligence providers. So we have data from app figures to share with you. They show that basically GTA as a whole, the trilogy package, was able to achieve 11 million downloads in its first week, and GTA San Andreas alone delivered 6 million downloads. So to give you more context, that's about 4% of the install base of members for Netflix, the 260 million people. So that's a pretty good number.
Yeah, and that was almost enough to make San Andreas the second most downloaded Netflix game of 2023. Storyteller, though, came in first with roughly 7 million downloads.
And to be clear, it may say more about the relatively low performance of other games not named GTA in the catalog. But the strong performance of GTA out of the gate clearly shows that Netflix games have potential with the right titles.
Yes. Now, according to the Wall Street Journal, Netflix is discussing methods to monetize its games, including in app purchases, premium pricing for top tier games, and then ads in games for those ad tier subscribers.
Mm-hmm. And we've covered the gaming market in other videos, but in short, mobile games is the biggest chunk. It's more than $110 billion in 2024. At least that's the forecast. And Netflix is already aiming at the right market, targeting mobile games.
Yeah, and so far they pushed back against ads and in-game payments, but Netflix's stance might change. We've seen that with the introduction of an ad-supported tier and the paid sharing.
Yep. And just recently, Netflix posted a job for a game director of a AAA game. So those are the most expensive games to make. They are just hinting at more expensive projects down the line. And so far, there is an estimated $1 billion that Netflix has spent on games across, its investments in studios and just across the gaming platform.
Yeah, and Netflix embraced a pretty cautious approach here, growing its catalog one title at a time. And this could pay off eventually. Games have a much higher ceiling in revenue per paying user, so Netflix wouldn't have to convert a significant portion of its subscribers to see meaningful results.
Yep. Okay, so let's talk about the elephant in the room, the big announcement that was made the same day as the earnings call, a new deal with WWE. So Netflix landed a 10-year deal. It's worth $5 billion and it secured exclusive rights to WWE's flagship program, which is called Raw. Starting in January 2025, this is basically Netflix's first major foray into live sports entertainment. And it will include rights to other WWE shows outside of the US, like SmackDown and WrestleMania.
Yeah, sports might be a little stretch, but I know when I was a kid, I definitely thought it was all real. So, WWE's programming is available in over 180 countries and 30 languages, reaching over 1 billion homes worldwide. And in 2023, the average viewership for Raw was 1.7 million.
Yep, and they are basically leveraging 7 hours of original content on a weekly basis. We have Raw on Monday nights, SmackDown on Fridays, that's on Fox, and NXT on Tuesdays on USA Network.
I feel like you can't say those names without being like Raw, SmackDown, and NXT. All right, so let's go ahead and look at how WWE makes money. So, for context, WWE has made over $1 billion in FY22 alone from its media arm across its network, including pay per view, content rights fees, that's where Netflix's payment will be accounted for, advertising and sponsorships, and more.
Yep. And so there is an extra 0.3 billion that comes from live events like WrestleMania, but also consumer products like Take-Two's video game or Mattel's figurines.
Yeah. And WWE Network, they moved exclusively to Peacock in 2021 in the US after mixed results with its own subscription. With Netflix, WWE is going to benefit from a much larger platform to reach fans, old and new. And in turn, Netflix gets exclusive content to mitigate churn and win back members with regular live events. So, really, it's a win win.
Yep. All right, so let us know what you think of this format. Would you like us to cover other companies' earnings like this? Well, let us know in the comment.
And in the meantime, please subscribe to our YouTube channel for more content.
All right. Peace out.